Today I'm going to show you how you can generate monthly or even weekly income on the stocks that you hold. The good thing about this strategy is that in addition to you generating income, it actually reduces the risk of you holding on to these stocks. Welcome to my channel where we are going to be financially smart together. Now, before we get into the strategy, please remember to subscribe and hit the notification bell so you won't miss out on future lessons like this. And as always, if you have any questions throughout this video, please put them in the comment section below. So to generate monthly or weekly income on your stock portfolio, we're going to be selling covered call options, which is where we sell a call option on 100 shares of stocks of a great company that you plan to own for the long run. And as a reminder, when you sell an option, you want that option to be worth zero by the time of expiration so that you get to keep all the premium that you received. With this strategy, I usually sell an out-of-the-money call option because it has a higher profit potential and less likelihood of my stocks being called away than if I were to sell an in-the-money call option. So let's see how this works. We're going to use CME for this example. And let's just pretend that we bought 100 shares of CME at $190, which is the purple line that you see. And right now, CME is at $206.64. So we're going to sell a covered call at $210 that expires in 30 days. We see that the covered call we want to sell has a bid price of $4.70, which means we'll be collecting a total premium of $470. And here I would like to quickly note that even though the bid price is $4.70, you can actually sell it for a bit higher, for example, $5, if you're not that desperate and are willing to wait for it to be sold. Let's calculate your return on investment. Right now, CME is at $206.64 per share, so your total CME portfolio value is $20,664. You sold a call option with a strike price of $210 that expires in 30 days for a total premium of $470 that you collected. So your return in 30 days is $470 divided by $20,664, which comes out to be 2.27%. And if you repeat this process 12 times for the whole year, then you'll have a yearly return of around 27%. If, for example, on the day that this option expires, CME is at $206 and you bought the stock initially at $190, then you will have an unrealized capital gain of $206 minus $190, so $16 per stock, and that comes out to be a total of $16,000. In this way, you can collect monthly income while waiting for your stock to appreciate. You can see here that there are also weekly options that you can sell to collect weekly premiums instead of monthly. When you sell a covered call, you get that money in your account immediately, and you can do whatever you want with that money. When you sell a covered call, there's 4 things that can happen by expiration date. The stock can trade around the strike price of the option. The stock can fall significantly below the strike price of the option. The stock price could be trading significantly above the strike price of the option. Or the call buyer exercises early, meaning you have to sell 100 shares of the stock before the option even expires, which rarely happens. Now let's see what you can do in each situation. If the stock price doesn't move much by expiration date, then you can roll the option forward to a further expiration date, but with the same strike price. If the stock price falls a lot by the time the option expires, or even before the option expires, you can roll the option forward and down, meaning buying back the option that you have and then selling an option with a further expiration date and a lower strike price. Or instead of rolling your option, you can just let your option expire worthless and sell to open another call option. If the stock price moves up by a lot on the day of expiration, or even before the day of expiration, you can roll the option forward and up, meaning buying back the option that you have and selling another option with a further expiration date that has a higher strike price. Or instead of rolling the call option, you can let 100 shares of your stock be called away and then buy them back either directly from the market or by selling a covered put option, which is a strategy that I cover in another video. You want to sell covered calls on stocks that you plan to hold for the long term. So this is not a short-term strategy because you need to hold 100 shares of the stock, which can fall to zero. So it's important you stick to stocks of great companies that you believe in. With that said, selling covered call actually reduces the risk of holding stocks because the premium you collect helps offset any losses. It also helps your overall portfolio be less volatile than just holding onto stocks alone. And it helps you generate income while you wait for your stocks to appreciate. It's best to sell when the implied volatility is high because that will result in higher option premiums you can collect. You will profit from the call option you sold when the stock is moving sideways, trending down, or moves up but stays below the break-even point, which again is the strike price plus the option premium. The only time that just holding onto stocks would actually outperform selling call options is if the stock price surges by a lot in a short amount of time. Which in my opinion, I wouldn't mind having my stocks being called away because usually when a stock surges, a correction will follow that lowers the stock back to its averages. Majority of the time, I make more money by selling covered calls than if I were to hold on to the stock and do nothing, especially when I have the power to adjust the trade like rolling the option. One thing to note is that if you really don't want your stocks to be called away, then you might want to avoid selling or holding onto a covered call position during earnings, because stocks have a higher chance of making a big move on earning announcement. On the other hand, implied volatility is usually higher before earnings, so if you sold a call option at that time, you might be collecting more premium than usual. That is, if you don't mind the risk of your stock being called away. And I say risk because it's actually not that bad. You're just putting a cap on your profit, but it's profit either way. With all that said, keep in mind that you don't want to sell a call option without first owning 100 shares of the underlying stock. And I'm bringing this up because you can actually accidentally do this. And this happens when, for example, you own 100 shares of the underlying stock, and on the day your covered call option expires, you sell another call option without closing out your first call option. This is a problem because option assignment decisions aren't made until after the market closes. So if your option expires on Friday, you won't find out until Saturday whether you're assigned. And there has been times where a buyer exercised the option even when it's out of the money because they expect the stock to spike up. The best way to do this is either to wait until Monday after your call option has expired before selling another call option, at which time your expired call option shouldn't be shown on your account anymore. Or by buying back your expired call option and selling another call option with a further expiration date, all in the same transaction. Now that you learned about selling covered calls, check out the video where I show you how you can use options to get stocks at a discount or even free.